Is Trade Desk the next big rebound story in tech? The stock is down over 40% in 2025. But here is a twist. Its business fundamentals are still solid and Wall Street sees the big upside. In this video, we'll break down why it has fallen, what's going right behind the scenes, and whether now could be the perfect time to buy in. So let's get into it. Welcome back to Stock Spy, where we analyze high potential stocks and help you make smarter investment decisions. If you're new here, consider subscribing and turning on the notification so you never miss an opportunity in the markets. So let's start with the obvious, why the Trade Desk stock was down 40% this year. Back in Q1 2025, Trade Desk missed their revenue expectation, coming in at $491 million instead of $505 million that Wall Street had hoped for. While that might not sound like a disaster, it was the first time in years that they have failed to meet top-line estimates. Add to that a cautious forward guidance from CEO Jeff Green, and investors started worrying that the company's growth trajectory may be slowing. The stock took a major hit after earnings hasn't fully recovered since. But here is what's interesting. Fundamentals haven't fallen apart. In fact, they remain pretty compelling. The Trade Desk operates in pragmatic advertising space, helping brands and agencies buy digital ad space in real time across platforms like streaming TV, websites, podcasts, and even connected devices. Their flagship product, the Solimar platform, is getting strong adoption. And in a world that's moving away from third-party cookies, their Unified ID 2.0 is gaining traction as a privacy-safe alternative. Even after earnings misses, operating margins remain nearly 17%, and the company still holds over $1.6 billion in cash with zero debt. This is not a broken business, it's a great company that stumbled, but now trades at a much more reasonable valuation. So what makes TTD different from other tech players? Number one, they don't operate on the walled garden model like Meta or Google. Instead, TTD is fully independent. That gives them a ton of flexibility and trust among ad buyers who don't want to hand over data to the giants. Secondly, the company has leaned heavily into connected TV. Think streaming platforms like Roku, Hulu, and Disney Plus. This area is growing rapidly as a traditional cable continues to die off. Number three, TTD's AI-powered bidding tools have made it one of the most efficient platforms for ad buyers. In the world where advertisers are cutting budgets, efficiency matters more than ever. Despite the stock pullback, analysts still expect the Trade Desk to grow revenue by 18% in 2025, accelerating to 20% in the following years. Earnings per share are forecast to climb 32% by 2026 and potentially 50% by 2027, assuming margin stabilizes and top-line growth continues. Those are some serious numbers, especially when you're buying in after a major correction. What's more, the total addressable market for digital advertising is expected to hit $1 trillion by 2030. TTD is carving out a niche in that market and they're not done yet. So let's see what the CEO has to say. Jeff Green, the co-founder and CEO of Trade Desk, hasn't shied away from the challenges. In recent earnings call, he emphasized that the company is making long-term investment in identity and data, which could suppress short-term earnings but build competitive advantages for years to come. He also highlighted that TTD is gaining share in almost every ad category it operates in, especially CTV and retail media. These are areas poised for explosive growth. This isn't a management team that's panicking, they are playing the long game. And so should the long-term investors. Of course, no investment is without its risk. Let's analyze the risks here. First, the digital ad market is cyclical. When economy slows down, ad budgets get slashed, and that hit companies like TTD directly. Number two, there is always a risk that Google's privacy changes or regulatory headwinds could hurt their unified ID efforts. Third, valuation. Although the stock has dropped, it still trades at a forward PE of above 50. That's not cheap, especially if the growth continues to decelerate. So yes, the trade desk has potentials, but if you also need to have a risk tolerance for volatility. Now here is a big question. Is now the time to buy the trade desk? If you believe in the future of streaming, AI in advertising, and privacy first ad models, then the trade desk is one of the best pure play options in the market. The current pullback could be a rare opportunity to grab a high quality business at a discount. If you're not catching a falling knife, you are catching a temporarily unpopular stock with long-term tailwinds and solid execution. It's a clear buy the dip candidate for potential investors. Just remember to size your position properly and do your own due diligence, and consider the dollar cost averaging if you're nervous about a short-term volatility. In summary, the trade desk may not be the hottest stock right now, but that's exactly why it deserves our attention. With a resilient business model, strong leadership, and massive long-term market opportunity, this beaten down stock could be setting up for a major comeback in the years ahead. Let me know what you think. Are you buying the dip on this one or staying on the sidelines? If you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and drop a comment with the next stock you want us to cover. Thanks a lot for watching. I'll see you in the next one.